Hi, welcome back. A couple of chapters ago, when I introduced the corporate finance as a discipline, I talked about the investment decision, the financing decision, and the dividend decision as being the three decisions that drive almost every business. The last session, we talked about the investment decision and how it plays out across the life cycle. In this session, I want to focus on the financing decision. Put simply, the financing decision looks at the mix of debt and equity that companies should take to fund themselves. So what I would do in this session is first start off by looking at what I call illusory reasons for why companies use debt or equity, the illusory trade-off. Then I'll move on to the financial reasons, the true pluses and minuses that should drive how much debt and equity you have. And then I'm going to introduce market frictions that might cause you to deviate from what might be right for you as a company. And as we talk about these reasons, we talk about how they play out across the life cycle. Let's start with the illusory reasons people give for either borrowing money or never borrowing money. I've heard people who borrow money argue that borrowing money will increase your return on equity. And technically the answer is yes, right? Because if you have less equity invested in a project or a business in general, you should be able to earn a higher return on equity, even after you make interest expenses. It's a heart of why real estate is so highly levered. But the argument is the less equity you have invested, the greater the chance you'll make a higher percentage return, higher return on equity. The second is that debt is cheaper than equity. And technically, it should be. Why? Because when you borrow money, the lender will charge you a risk-free rate plus a default spread, but equity investors have to worry about all kinds of risks and build into the cost of equity. They're both illusory, because while the return on equity will increase as you borrow more money for most investments, so will the risk of equity in those investments, the cost of equity. And since the trade-off is by comparing those two, I don't see the benefit of borrowing money just to push up your return on equity. On the debt is cheaper argument, the debt is cheaper simply because lenders are ahead of you in line as equity investors. It actually makes the rest of your equity more risky, so the illusion of debt being cheaper than equity very quickly disappears once you bring in the composite cost of capital. In terms of reasons why companies don't borrow money, in illusory reasons, the first is if you borrow money, you will have lower net income. And of course, that's absolutely true, right? Because you got to make interest expenses that come out of your income. But remember, you also have much less equity invested in the company. So even though your net income might drop when you borrow money, if you have half the equity invested before, you might still come out a winner after the process. The second, and this is I think a reason I often hear from family group companies, they'll tell you that equity is either very cheap or free. At the heart of this illusion is the belief that the true cost of equity is the dividends you pay to equity investors. And in most companies, that dividend yield is going to be lower than the interest you pay on debt. In fact, if I bought into this reason, companies that don't pay dividends, the equity is free. I should be raising as much equity as I want. The truth, though, is people buy your equity because they expect price appreciation. That price appreciation has to be built into your cost of equity. But these illusory beliefs about what makes debt good or bad drive a lot of bad decision making, and you see it play out across the life cycle. I've seen young companies go out and borrow money, venture debt, because they argue that venture debt is cheaper than venture equity. The cheaper debt argument. Again, it makes no sense because that venture debt is cheaper than venture equity because those lenders have first claim on the cash flows. At the other end of the spectrum, you often see mature companies that refuse to borrow money. We talked about family group companies. I know of family group companies that have zero debt, even though they're mature, stable company with lots of earnings and cash flows. And what's driving their decision-making process is somehow this belief that equity, at least in their hands, is free or very cheap and debt costs them money. Let's move on to the true trade-off on debt. In a couple of sessions ago, when I introduced this trade-off, I talked about the biggest benefit of debt being a tax benefit, and that remains the case. If you took away the tax benefits of debt, the biggest reason for borrowing money would go away. And that tax benefit comes from what's in the tax code. Interest expenses are tax deductible. Cash flows to equity have to come out of after-tax cash flows. There are some parts of the world where this is not true. In much of the world, though, this is true. And the higher your tax rate, the greater the tax benefit to borrowing. There's a secondary benefit to debt. Debt can make some companies more disciplined in the way they approach project choice. And let me explain why. Let's say you're the manager of a mature company with lots of cash flows and no debt. You know what? You can get sloppy in your project choice. You can take bad investments and nobody's going to notice because you have the earnings and cash flows to cover up your mistakes. You know how I can make you more disciplined? I can force you as management of this company to go out and borrow money. Now you got to make interest expenses. Now you take those bad investments, there's a consequence for you. The consequence is you could drive the company into bankruptcy, you'd lose your job. It's an extreme way of getting somebody's attention, but it's an argument that debt can make you more disciplined as a management team. Tax benefits and added discipline are the two biggest benefits of debt. On the other side of the spectrum, when you borrow money, you increase the likelihood of being in distress, of going bankrupt. What does that do? It puts your entire future at risk. And if you're a company with more variable earnings, you have to worry about this more. So even though you might have the earnings right now to cover your interest expenses, you got to look into the future and say, if I go out and borrow this money, will it increase the chances I could get into trouble? Because if you are perceived as being in trouble, even though you might not go bankrupt, there's still bankruptcy costs. Bankruptcy costs because your customers might stop buying your products, your suppliers might start demanding cash. That's the biggest cost to borrowing money. It puts you more at risk of that happening. There's a secondary cost. Remember we said there were two ways of raising capital, debt and equity. And that's a trade-off we're looking at. But the interests of the two groups are very different. Equity gets a residual claim, debt gets at first contractual claim. What's good for lenders might not be good for equity investors. Let's get specific. Lenders would prefer that you take nice, stable, predictable projects. Equity investors might want you to go for riskier projects with more upside. That's called an agency cost because when lenders lend money to companies, they've got to factor in that difference in interest and build it in either as a higher interest rate or as bond covenants, restrictions on you as a company. So as a company, the true trade-off is between the tax benefits and the added discipline and the bankruptcy cost and the agency cost on the other side. And that trade-off is going to determine how much to borrow. So let's take a look at how the items in those trade-offs are going to shift as you look across the life cycle. Let's start with tax benefits. First, recognize how the tax benefit of debt works. When you have $100 million in interest expenses, the tax authorities don't mail you a check for $30 million, if 30% is your tax rate. To get the tax benefit, you need to be making money. Tax benefits to debt if you're a money-losing company that doesn't expect to make money in the near term. And let's look across the life cycle. What I've looked at here is a graph where I've looked at the percentage of money-making and money-losing companies by where a company is in terms of the age decile. If you look at the youngest companies, almost 73% of companies are money-losing. For young companies, if you're money-losing, the tax benefits of debt start to dissipate. So if you think in terms of money-making and money-losing, even if the marginal tax rate stays the same for every company, the potential tax benefits to borrowing should be greater for companies later in the life cycle than earlier in the life cycle, simply because young companies don't make money. Let's move on to added discipline. Remember we talked about what creates discipline, creates the need for discipline is managers with no oversight. But what if you had an insider in the company who's also part of the management team? A CEO owns 15% of the company. You know where I'm going with this, right? If you have an insider who's a big shareholder, who's also part of the management team, you might not need debt to make you more disciplined. So here's what I looked at. I looked at the percent of shares held by insiders and institutional investors, again broken down by age decile. If you look at the youngest companies, they tend to have the lowest percentage of shares held by institutions. Institutions tend to be passive investors. They let you do what you want. And among the highest percent of shares held by insiders. Again, this might be a reach, but if you look at the institutional insider holdings, you can see why the need for discipline is far greater at older, more mature companies than at younger companies. So neither the tax benefits nor the added discipline create much benefit for younger companies. they create more benefits for larger companies. Let's move on to bankruptcy costs. Every company, when it borrows money, faces the threat of bankruptcy. But that threat of bankruptcy is greater if your earnings are more volatile. So in this table, what I've looked at is the variability in operating income, again broken down by age decile. If you look at the youngest companies, they have much more variable operating income than older companies. So basically, if you're a younger company, even if your money making can get the tax benefit, you might not borrow money because you have volatile earnings. Those earnings which are positive now could become negative in the future. The other way to think about bankruptcy costs is to think in terms of coverage ratios. What multiple of interest expenses do you have as operating income? It's called the interest coverage ratio. Companies with low coverage ratios are closer to the edge. They have to worry more about bankruptcy risk. And guess what? Younger companies have much lower interest coverage ratios, are closer to the edge. Much greater risk and cost of bankruptcy at young companies and older companies. And in terms of agency costs, as a lender, your concern when you lend to a company is you can't monitor what people do. Lenders seem to feel this problem more when they lend to companies with intangible assets, things they cannot see. And let's face it, growth, which is a big part of value for young companies, is intangible. You can't see it. In addition, with mature companies, you have a history of how they operate. So you worry less that management will do something unpredictable. Put simply, if you're a lender, you worry more about lending to young companies than to more mature companies because more of their assets for young companies are intangible and the management has less of a history. You say, why should it matter? Because if you're a young company and lenders worry about lending to you, you're the one bearing the cost because they either charge you a higher interest rate or they restrict your actions. They write in covenants and things you can or cannot do. So let's see where we are. The benefits of debt are much lower to young companies than to older companies. The costs of debt are much higher to young companies than to older companies. You know where that's going to lead you, right? If this trade-off is the right one, you should expect to see younger companies borrow a lot less than older companies simply because they can't afford to. And when you look at debt ratios across the life cycle, and I've looked at both book and market debt ratios, debt as a percent of total capital, you see the patterns are as predicted. Young companies have the lowest debt ratios in both book and market terms. Oldest companies have among the highest debt ratios. And if you look at, earlier we talked about age being a good proxy for where in the life cycle, at least in terms of the debt mix, you see the debt mix play out as companies move through the life cycle. Now, there are, of course, frictional trade-offs that can lead companies to deviate from that script. What is a script? Script basically says young companies should borrow very much money, older companies should borrow more. Let's talk about the frictions that can lead companies to do something different from what that trade-off would suggest. The first is that if you operate in a country or in an environment where in the event of bankruptcy, firms are protected from default because, by governments or entities coming in and bailing them out. Because remember, bankruptcy threats reflect the fact that when you get in trouble, you're shut down and the lenders take over your assets. But what if you're bailed out? If there's significant bankruptcy protection from bankruptcy because of bailouts, you might borrow more than you otherwise should. When you think about subsidized debt, where governments or entities lend you money at below market rates, you might borrow more than you should. So if you're a company that shouldn't be borrowing money, but I offer you subsidized debt, which green energy companies often have, you might borrow money. And thirdly, with young companies, there is this issue of control. Founders are still running the company often, they value control. And when you raise fresh equity, you're putting that control at risk. So you might borrow money even though it's not the right thing for you because you value control so much. I'm not suggesting any of these are healthy things to do. To go out and borrow money because you think you're going to be protected in the event of a bankruptcy, or to borrow money because it's subsidized, or borrowing money because you don't want to give up control. You're still doing the wrong thing from a fundamental perspective, but I can understand why you borrow money. On the other side of the spectrum, companies that should be borrowing money sometimes don't. And here again are some of the reasons. One is, remember we said that lenders put in covenants, restrictions on what you can or cannot do. If you're a company that values flexibility, you might choose not to borrow money because you don't want your hands to be tied. If you look at the big tech companies in the US right now, they're all money machines, but they have very little debt. And I think one reason is they still value flexibility to be able to move into new businesses. Second, if your equity is overpriced, markets are paying too high a price for your shares. Why? Because irrational exuberance maybe. You might decide to use equity even though it's not the right way of raising capital because people are overpaying. And finally, if you have regulatory restrictions on debt, you might have to issue equity even though debt might give you much more in terms of tax benefits. So these frictional trade-offs exist, and I recognize they do, and it might explain why you see some young companies that shouldn't be borrowing money, borrow money anyway, and some more mature companies that should be borrowing money that don't borrow money because those frictional trade-offs push them off the game. I'm going to close off this session though by using a tool you can use to come up with the right mix of debt and equity for your company. In the investment decision session, we talked about the cost of capital as a hurdle rate, and we said the cost of capital is a weighted average of your cost of equity and your cost of debt. Now, usually when you compute the cost of capital of your company, you do it at the existing debt ratio. But what if you could compute the cost of capital at every conceivable debt ratio from 0% to 90%? I'm going to argue that the right mix of debt for you is that which minimizes your cost of capital. Here I've taken a hypothetical company and computed its cost of capital as its debt ratio goes from 0% to 90%, or to 100%. At a 0% debt, you're all equity funded, your cost of capital will be your cost of equity. As you go from 0 to 10 to 20, notice that your cost of capital decreases. The benefits you're getting by replacing more expensive equity with cheaper debt are working in your favor. The pluses of debt are outweighing the minuses. But that doesn't last forever. In fact, by the time you get to 40% debt, you're starting to run out of that trade-off. And as you push your debt ratio above 40%, your cost of capital rises again. You're still using debt to replace equity. The debt is still cheaper than equity on that marginal capital raise, but you're pushing up your cost of capital because the minuses of debt are outweighing the pluses. At least for this hypothetical company, the optimal mix of debt and equity would be 40% debt, 60% equity. You're saying that's nice in the hypothetical, but how am I going to do this for an actual company? Because for an actual company, all I have is one debt ratio and one cost of capital. It's doable, and here's what you'd have to work through. You'd have to compute your cost of equity and your cost of debt at every debt ratio. And that number will change, right? Your cost of equity will change because as you borrow more money, your equity will become riskier. Your earnings are more volatile. Equity investors get more concerned. Your cost of equity at 40% debt will be higher than your cost of equity at 20% debt. For the cost of debt, the same kind of dynamic will play out. If I'm a lender lending to you, I'm going to have a much lower cost of debt for you if you're at 20% debt than if you're at 40, 50, 60% debt. Put simply, your default spread will get larger as you borrow more money. And along the way, you got to make sure you're not losing your tax benefits, because if you borrow too much money, you might have interest expenses that exceed your taxable income. And then you lose the tax benefits of debt. So there are multiple things at play, but what you cannot do is leave the cost of equity and cost of debt fixed and just change the mix of debt and equity. So in a true cost of capital calculation, everything will be in motion. I do this for companies regularly, and it's not difficult to do if you follow a process. My cost of equity, if you remember when we talked in the investment section, we talked about the cost of equity as coming from the risk-free rate, the equity risk premium, and the beta. The risk-free rate and the equity risk premium are not changed. They're market set numbers. But your beta is a function of how much debt you have as a company. In fact, one of the three determinants. So the way I estimate beta as the debt ratio changes, I start with the beta you'd have had with no debt. It's called an unlevered beta. And then I adjust that beta for how much debt you take on. It's called levering the beta. And that levered beta will get higher as I have a higher debt ratio. So as you borrow more money, your beta will go up. As your beta goes up, your cost of equity goes up. For the cost of debt, I follow slightly more convoluted process. Remember, all I have, even if you're a rated company, is you're rating at your existing debt ratio. My challenge is estimating what would happen to that rating if I increased your debt ratio from 20 to 30 to 40%. And here's what I do. As I increase the debt ratio, I compute the interest expenses you will have at that debt ratio. I compute an interest coverage ratio. Remember, the interest coverage ratio measures how much buffer you have. And then I have a lookup table where I use the interest coverage ratio to estimate your rating. Cutting a long story short, your rating might start at AAA, but as you borrow more money, it's going to slide from AAA to AA to single A. And as the rating changes, I'm going to change the default spread and change your cost of debt. And I'm going to check the tax rate to make sure I'm getting the full tax benefits. The cost of capital now can be computed for any company because the cost of equity, the cost of debt, and the tax rate all come into play. So I'm going to take 3 companies at different stages in the life cycle. Airbnb, Adobe, and Kraft Heinz. I've computed their corporate age. Airbnb is 15 years old, Adobe is 40 years old, Kraft Heinz is 153 years old. And if you think in revenue growth and margins, these are companies at very different stages. Airbnb is a young company, Adobe is a high growth company, maybe a high growth, mature growth company, and Kraft Heinz is mature, sliding into decline. I computed the cost of cap for each of these 3 companies at every conceivable debt ratio. And you can see the graphs here. And in the table to the left, I've computed the optimal mix of debt and equity for each of these companies. The optimal mix of debt and equity for Airbnb is 100% equity. The optimal mix for Adobe is 20% debt, 80% equity. And Kraft Heinz is 50% debt, 50% equity. Kind of makes sense, right? Young company, very little or no debt. Growth company, slightly more debt, mature company, the most debt. And if you look at what's causing these optimals to vary across companies, it's actually very simple. It's how much these companies generate as earnings or as cash flows relative to their market value. Airbnb has an enterprise value of $67 billion, an operating income of $429 million. It generates, if you divide the operating income by the enterprise value, an EBIT as a percent of enterprise value of 0.64%. Kraft Heinz at the other extreme has an EBIT as a percent of enterprise value of almost 8%. You're saying, so what? Remember that to get the tax benefits of debt, to be able to service debt, you have to earn money now. If Airbnb goes even to a 10% debt ratio, be $6.7 billion debt, it's going to have trouble making those interest payments. No wonder its optimal debt ratio is 0%. Adobe has a little more slack. That's why its optimal debt ratios, it's got cash flows and earnings which are higher than Airbnb's. As you move through the life cycle, how much companies can generate as earnings or cash flows relative to their market value will go up. And as it goes up, their capacity to borrow money will also go up. So I hope you found this session useful because it kind of gives you a way of thinking about optimal debt ratios and how they vary across. Having said all of this, though, about computing the optimal debt ratio for your company, let's face it, most companies, if you ask them how they come up with their debt ratio, will tell you they look at other companies in their peer group and they try to stay as close as they can to that peer group average. You think that makes no sense? It actually makes complete sense from this perspective. If you're the CEO or CFO of a company, staying close to a peer group gives you cover. Cover in what sense? If something goes wrong, your defense is everybody else was doing it. That's why I call this Me Too finance. And a lot of debt mix choices are made in Me Too finance. Assuming you play Me Too finance, again, let's look across the life cycle. It's easier to play Me Too finance if you're a mature company, like a mature steel company, and you're in a business filled with mature steel companies. You could make the argument what they do is going to be pretty close to what you should be doing. If you're a software company, though, a young software company, and all your companies around you are software companies, but they vary across the life cycle, much more difficult to come up with a sense of what the peer group does. So I would argue that even peer group assessment becomes more difficult at young companies, which might, if they're following their own sense, if they're following common sense, should lead them to borrow less money. So that's the mix of debt and equity that drives your choice as a company. What about the right type of debt? The right type of debt is the debt that best matches your assets. If you ask me to find the perfect debt for you as a company, I'm going to look at your projects and the investments you make, and I'm going to ask you a series of questions. I'm going to ask you, for instance, how long term is a typical project? You say 20 years, the right kind of debt for you is 20-year debt. I'm going to ask you what currency your cash flows in. You say 60% euros, 40% dollars. I'm going to say your debt should have the same mix, 60% euros, 40% dollars. If you're facing inflation that's volatile over time, I'm going to ask you about pricing power. Do you have the capacity to pass inflation through? You're saying, why does that matter? If you have the capacity to pass inflation through into pricing, then I'm going to argue you're a much better candidate for floating rate debt. If you're a young growth company and and you're looking to borrow money, then I'm going to argue that convertible debt, where we have low coupon payments now, but you have the potential to convert into traditional debt in the future, is a much better choice for you. And finally, I'm also going to ask you about what else affects your cash flows. If you're an oil company, it might be oil prices. And if I can build that into your debt, I'm going to do it. See what I'm trying to do here? I'm trying to design a debt that behaves the same way as the cash flows from your projects do, that matches up. Why? Because by doing that, you reduce your default risk. Now, if you look across the life cycle and you think about doing this, we've already talked about the amount of debt you can carry, much less for young companies than for older companies. If you carry this principle through to the life cycle, you should expect to see younger companies, when they borrow money, to have very different kinds of debt than older companies. I would expect younger companies to use more convertible debt, tie the coupon payments on the debt or the interest payments on the debt to how well they're doing. More mature companies are more likely to use conventional debt, straight debt, fixed rate debt, because that's more reflective of where they are as businesses. So look across the life cycle and the financing principle. As you go across the life cycle, I would expect the amount of debt you carry to change from very low or non-existent when you're a very young company to more debt when you're a more mature company. And when you go into decline, that you manage your debt, because as your earnings drops off, your debt should drop off as well. In terms of financing type, early in the life cycle, I would expect you to use your equity as ammunition when you borrow money. Convertible debt has a conversion option, which is equity. In fact, many young companies you'll see often use equity warrants as a way of raising money, even though they might slap the name of debt to it, because almost all of it is options. As you go through the life cycle and become more mature, you're going to see more conventional debt. So both the mix of debt and the type of debt should shift as you move across the life cycle. I hope you found this session useful, and then thank you very much for listening.